Okay, so today's lesson is on ethics and the accounting profession. So, exam questions on ethics. So, it's a relatively new addition to the specification. And what we're going to be looking at is you'll be given a scenario where there's potential ethical dilemma. And what you'll have to identify is the ethical principle that might be broken, the threat or motivation to break the principle, and any actions that you might need to take to ensure that an ethical principle is not broken. Kind of look like that. So that's a 25 marker. You've got a basic case study with some potential ethical dilemmas. What you've got to do is identify whether or not you believe there is an ethical dilemma, what ethical principle may have been broken, why that ethical principle may have been broken in the threat, and what the company can do in order to make sure that the ethical principle isn't broken. Relatively straightforward, but you've got to know some key terms. So, ethicals do deal with ethical dilemmas on a daily basis, and we can narrow those down to 5 ethical principles: integrity, objectivity, professional competence and due care, confidentiality, and professional behaviour. So you're going to have to apply one or more of these principles to each item within the case study. First one then is integrity. And the basics of integrity is that you must always act in a straightforward and honest manner in all professional dealings. So, for example, on a really basic level, the recording of a transaction must always be honest. Overstating or understating a transaction will lead to financial statements which do not show a true and fair view. You must also be honest with your stakeholders, though. So, potential investors, members of staff. It's just making sure that whatever information you pass on to people is honest. Remembering that one of the main functions of being an accountant is communicating financial information. So our communications should always be honest and always show the highest standards of integrity. So if you ever believe that someone is lying, or if you ever believe that someone is not giving you the full truth in any business transaction, then they are breaking the ethical principle of integrity. Next one we got is objectivity. So we already know there's a concept called objectivity. This is pretty much exactly the same. It means removal of any bias from the decision. So dealings must be transparent and fair. So you've got to make sure that you are confident in your decision making, that you're able to reveal the process. You've got to be happy that everybody who is affected by your decision understands and is happy with the way you came to that decision. And you've got to make sure that all those stakeholders are happy and that decisions are fair to all. Now, I've just said that you've got to make sure all your stakeholders are happy, and that is true. But you've got to remember that not everyone's going to be happy with every decision you make. But you've got to be as fair as possible, and within your decision making, you've got to consider the views and points of view of each and every stakeholder. You're not always going to make them happy, but they should understand how you came to the decision that you made and believe that it was a fair decision-making process. So, for example, should you be building a new factory in one of the areas of Tameside, you would need to consider each of those areas, why you've chosen that particular area, and understand that people in, say, Staley Bridge may not be as happy about a decision in Hyde as the people of Hyde. But they would have to understand how you came to that decision. You've got to be confident in revealing the process. Next one is professional competence and due care. Essentially, this means not winging it. So you've always got to make sure that you're well prepared for everything that you do. Stop laughing. So all accounting staff must only complete tasks that they've received adequate training in. Professional standards and company law must be adhered to, and knowledge should be maintained and kept up to date. So the example I've given is, if you are asked as an accountant to advise on a merger, but you've never had the relevant training in it, then you shouldn't be involved in that decision-making process in any form of merger or acquisition at all. So those of you who are looking at your apprenticeships at the moment, you'll know you can go into audit, you can go into all sorts of different varieties of being an accountant. If you're an auditor and you're asked to deal with mergers, you've probably not had the training. So if you were to advise somebody about a merger, having never had the training, then you're basically winging it. You're making it up as you go along because you don't know the full details. So we should always make sure that we're up to date with our training, always make sure that we understand the laws around whatever we are advising our clients. Next one is confidentiality. So information acquired through business dealings should never be passed on to a third party unless you've got permission or there is a legal duty to do so. So if someone's breaking the law, you can obviously tell the police or HMRC, but otherwise you should not break confidentiality rules. So giving advice to family, friends, or associates regarding a potential investment in a client. For example, so if your client has had a bad year, but you've looked at their accounts and you think these could do really well next year, these would be a brilliant company to invest in, you can't give that advice to your family, friends, or anyone close to you, as you're breaking confidentiality. There is potential that you would do your client out of extra investment, as your family and friends will want it as cheap as possible. So yeah, do not pass on any information to any of your family or friends about anything you may have heard from a client. Also, you're not allowed to allow the submission of misleading accounts or tax returns. Okay, if you know something is wrong, then you have to speak up as an accountant and you have to say that is wrong, and I am happy to break the confidentiality rules by passing that information on to the relevant authorities. Silence makes you complicit. Silence makes you complicit. So if you have been involved in the audit of a company and you see within those accounts that they have willfully overstated the value of their profit, and if you stay quiet about that, then by your silence, you are basically condoning it, and that is breaking an ethical principle. You should not do that. Next one we've got is professional behaviour. So you must always be professional at all times. So you must comply with relevant laws and regulations and avoid bringing the accounting profession into disrepute, which means giving the accounting profession a bad name. And you've also got to be able to deal with pressure, either real or perceived. So within your professional behaviour, as we said before, with the confidentiality, with the integrity, decision making must not be influenced by sympathies towards others, whether that be an organisation, its staff, or its members. Decisions must abide by the law. Also, in relation to this dealing with pressure, we may be not the highest ranking accountant in the company, but if we find out that our senior members of staff, the boss, whoever it may be, if they ask you to do something that you believe is illegal or unethical, you must speak out about it. Again, just complying with people's requests and being silent in the face of illegal activity makes you maybe not complicit, you won't go to prison, but you are breaking the ethical code, and it can stop you being an accountant. It can stop you, it can take away your chartered status. So, as well as those 5 ethical principles of integrity, objectivity, professional constant due care, confidentiality, and professional behaviour. We also have the threats to the fundamental ethical principles. Self-interest, self-review, familiarity, intimidation, and advocacy. So these are the situations or occasions in which the accountant's actions may be questioned. So it might not always be that you're breaking the ethical code, but you need to make sure that you don't put yourself in a position where their principles can be questioned, where your principles can be questioned. So these 5 items are the motivation to break the ethical principles. So each of these 5 things could cause you to break the ethical code. So the first one is self-interest. This is relatively self-explanatory. It's where you can benefit financially or otherwise from a situation. Any personal gain that you get from dealing with a client could be defined as self-interest. So, for example, an auditor may be offered a gift by a client. So the underlying implication is that the acceptance of the gift may lead to beneficial treatment or willingness to keep quiet about issues found within the accounting process. I'll give you an actual real life example. So a good friend of mine is an accountant, and he was offered the chance to use a box at Old Trafford in order to watch a game by a client. Full on meal, drinks, the whole lot. I think he even got to meet the players afterwards if he wanted to. And he had to turn that down because accepting that gift from his client may have caused people to think that he's willing to overlook certain things within their financial accounts that they don't want the rest of the world to see. So this was a threat to him potentially breaking the ethical code. We also have self-review. So this occurs when an auditor has to review work that they previously performed. So sometimes accountants will prepare the financial statements for companies and then audit them themselves. They shouldn't really do that. That is a self-review threat, because there's a risk that the auditor would not identify any shortcomings in their own work. So for example, you may go and work for a small company as their auditor. They may not have an in-house accountant. So they may have prepared the accounts up to trial balance, and then you're just going to do the income statement and the balance sheet for them, and then audit the rest of their accounts. Now, that seems okay and fairly reasonable. However, if you are to prepare their financial statements, it might be deemed that you may have overlooked errors that you yourself has made. And that could be deemed a self-review threat, which could lead you to breaking one of the principles that we mentioned earlier. We've also got advocacy, another of our threats. So this can occur when the auditor is asked to promote or represent their client in some way. In this situation, the auditor would have to be biased in favour of the client and cannot be objective. So this tends to happen where you've got 2 companies competing with each other that you represent both of them. Now, it could be that you favour one client over another because one client gives you more in terms of audit fees than the other. You shouldn't really be giving bias towards one over the other. And it can also happen when you're asked to do extra work for them. So promote their shares for a stock exchange, as it says there, or if the client asks the auditor to represent them in court. Now, you can represent people in court, should it be part of your job. But if you are asked, for example, to write a letter to the court to state that a company doesn't have liquidity problems and therefore shouldn't be wound up or put into administration, then you shouldn't really be doing that because, well, you don't know. They could be hiding information from you. So that is a potential threat and it may cause people to think you again are breaking one of the ethical principles. Familiarity, big threat, this one. This is the one that possibly comes up the most. So it's when it's deemed that an accountant has a close relationship with a client, be it a family member or a personal friend. Obviously, we all have relationships with our family and friends that we don't want to break. So it might be deemed that this familiarity will cause us to, again, overlook errors that they make or any fraudulent activity that they may be a part of. We don't want to get them in trouble. So what you shouldn't do is work for a client who you are a family member of or a personal friend of. And as it says at the bottom there, this can also happen after a long association with a client. If you are doing the audit for a company for many, many years, you're going to, by very nature of being a human being, you're going to develop a friendship or at least a kinship with somebody within that company. And you don't want them to get in trouble. You don't want to, and therefore it could be deemed that you're offering them preferential treatment. And we shouldn't really be doing that, because that again would break our ethical principles. So don't be too familiar with anybody you work with. Lastly, we've got intimidation. Unfortunately, relatively common in the real world. It can occur when the client is seen to harass or bully the accountant to give him preferential treatment. So if you are threatened by a client that they may use another auditor unless you give them preferential treatment, you should just walk away. Because if you were to take that client on, knowing full well they bullied you, then, well, again, you could be breaking one of our ethical principles. Now, the Institute of Business has produced an ethics test. This is the three elements that we should think about when making any business decision. And this relates very much so to accounting ethics. So the Institute of Business states the three elements are transparency. So do I mind others knowing what I've decided, how I came to that decision. So again, it's just about being open with your decision making so that all stakeholders understand, or at least are able to ask how you came to that decision. You should be open and honest with reasoning for every decision you make. You should also think about who your decision affects or hurts. Now, in accounting terms, it's most likely going to affect their willingness to pay tax, so HMRC. It could hurt our stakeholders in terms of staff, because we may be trying to reduce our profits in order to make staff redundant, etc., etc. And we should also think about fairness. So would my decision be considered fair by those affected? So if you explained it, if you were transparent in your decision making, would those people who it potentially hurt, would they think that decision is fair? Now, obviously, you can't make everyone happy all of the time, but they should understand how you came to your decision and why you came to your decision. So, dealing with ethical problems. First and foremost, if the law is broken, report it. Report it. Yeah, anytime that law is broken, you should be on the phone to the police or to HMRC and letting them know that someone has willingly broken the law. If they're unwillingly broken the law, it's your responsibility to persuade them to change their behavior, potentially change their financial statements, to admit to their mistake. That's absolutely fine. But if they've willingly broken the law and they're not willing to change their mind, go to the authorities. Unwilling, persuade them. Explain to them why it's wrong and how they can do things better. So, steps to resolving an ethical conflict. Obviously, you need to know all the facts in the first instance. Identify if there even is a problem. So sometimes we can perceive that somebody has broken an So sometimes we can perceive that somebody is breaking the ethical code and they might not be. So we must make sure that we have all the facts before we start throwing around accusations. Think about whether the behavior is unethical or illegal. If it's illegal, do as we said before, get in touch with the authorities. Then what you're going to do, certainly within the exam question, you're going to identify the principles affected. So you're going to identify which of those ethical principles is being broken. Then you need to think of the reasoning why that ethical principle may be broken. What threat is there to breaking the principle? Identify the principle and then say, you're breaking this principle because you're familiar, or you're breaking this ethical principle because of intimidation. The next thing that you're going to do is identify possible courses of action to resolve the problem. So you yourself can refuse to be part of it by resigning from your position or refusing to work with the client. You can try and persuade them to do things correctly and do things better. Again, we've got resign. Or one of the things that you can do is you can share work with other accounting firms. So for example, one thing that often comes up is one client, in fact, I'll take you back to it. Let's have a quick look at the exam question again. So on this very first one, the first one is the fee for the audit of Mono PLC provides 30% of the total fees for the company. Now, if we really think about that, that's 30% is quite a lot of your income, right? So which of the ethics would we be breaking there? Well, potentially integrity, because are we going to be honest about their transactions? We don't want to lose that client, so we could potentially overlook some of their errors within the accounts because we don't want to lose 30% of their business. Are we going to be objective? Are we not going to be a little bit biased? Because again, 30% of our client base, quite a lot. Nobody wants to lose 30%. So we must make sure that all our decisions, etc., when dealing with that client, are open and honest. In terms of the threat, it's a self-interest threat, isn't it? You don't want to lose 30% of your business because that 30% is going to come out of your pocket if that client goes elsewhere. So going back to resolving this ethical conflict, what we could do is, rather than lose 30% of our business, we could share that 30% with another accounting firm. We could either ask them to double check our audit, or we can merge with them in order to share their customers, and we'll share our customers, reducing that 30% down to a much smaller percentage. Or we could simply ask one of the accounting bodies to come in and help and to advise. They may be able to offer advice in that situation. So the last step is, if you don't know what to do, to seek external help. So go to one of the accounting bodies. So whichever accounting body you are chartered with, be that CIMA, ACCA, whatever it may be, go to them and ask them for their advice if you are not sure what to do. And if you're still not sure what to do, go to the authorities, speak to HMRC, and they will help you. So just to review, what you guys need to know is you need to know each of the 5 ethical principles and what they mean. Be able to apply them to a given situation. And then, oh, I've gone past it. Really professional, isn't it? Winging it. Once you've identified the ethical principle, identify which of the threats to the ethical principles may exist. So why are people potentially breaking the ethical code? Is it because of self-interest, self-review, familiarity, etc.? Once you've got that, you need to explain how you would get out of that problem. What steps would you go through in order to resolve the ethical conflict? And that is how you answer an ethics question.